Have you ever wondered why most traders lose money even when they use the exact same indicators as the professionals? The answer shocked me many years ago, because the indicator was never the problem. The trader was. I spent decades studying price movements, market psychology, and human behavior, and after making millions, then losing millions, then making them back again, I discovered something that most traders never understand. The market doesn't reward intelligence, it rewards discipline. Of the simplest tools ever created can reveal the direction of the market with incredible clarity: the moving average. But here's the mistake nearly everyone makes. They use the wrong settings. They jump from one strategy to another. One week, it's a 9 EMA. The next week, it's a 200 SMA. Then someone on social media tells them to use a 21 EMA. And before long, they're drowning in indicators while completely missing what the market is trying to tell them. Today, I'm going to show you
the only moving average settings you truly need for every time frame. Not because they're magical, not because they're secret, but because they help you see what the crowd cannot. And in this business, seeing what others miss is where fortunes are made. Let's begin the first lesson. Price is king. Before we talk about moving averages, you must understand something. Price comes first, indicators come second. Most traders reverse this relationship. They stare at indicators waiting for a signal. Professionals watch price and use indicators only for confirmation. A moving average is nothing more than a visual representation of what price has already done. It smooths out the noise. It helps you identify the dominant trend, and trends are where the real money is made. I never became wealthy predicting tops and bottoms. I became wealthy by identifying major trends and sitting patiently while they unfolded. The same principle applies today. The why most traders fail with indicators.
Market has changed. Human psychology hasn't. Fear and greed still drive every candle you see on your screen, and moving averages help expose that psychology. Daily chart, the 50 EMA and 200 EMA. If I could only use two moving averages for long-term trading, I would choose the 50 EMA and the 200 EMA. Why? Because they reveal the market's true health. Think of the 200 EMA as the market's heartbeat. When price remains above it, institutions are generally accumulating. When price falls below it, weakness begins to appear. The 50 EMA acts as the intermediate trend. It tells you whether momentum is strengthening or weakening. When the 50 EMA crosses above the 200 EMA, many call it a golden cross. When the opposite happens, they call it a death cross. But don't become obsessed with the crossover itself. Focus on what it represents: a shift in crowd psychology, a shift in money flow, a shift in trend. And trend is everything. Imagine trying to swim against a powerful river. That's exactly
What traders do when they fight the major trend. The river always wins. The 4-hour chart, the 20 EMA and 50 EMA. Now let's move down to the 4-hour chart. This is where swing traders find opportunity for this time frame. I prefer the 20 EMA and the 50 EMA. Why? Because they respond faster to changing market conditions. The 20 EMA acts like a guide rail during strong trends. Notice how price often pulls back to the 20 EMA before continuing higher. That pullback creates opportunity, not excitement, not prediction. Opportunity. Most traders chase price after a large move. Professionals wait patiently for price to come back to value. The 20 EMA helps identify that value area. The 50 EMA serves as additional confirmation. When both moving averages align with price direction, probability begins shifting in your favor. And trading is a game of probabilities, never certainties. The 1-hour chart, the 20 EMA. The 1-hour chart is where many traders spend their time. And if you're trading this time frame, simplicity becomes even more important. A single 20 EMA is often enough. Yes, one moving average. That's it. The reason is simple. Shorter time frames contain more noise. The more indicators you add, the more confused you become. The 20 EMA allows you to quickly identify whether momentum is bullish or bearish above the line. Buyers control the market below the line. Sellers control the market. Seal. Remember this. Complexity is often the enemy of profitability. The greatest trades of my career were rarely complicated. They were obvious. I simply had the patience to wait for them. The 30-minute chart, the 9 EMA and 20 EMA for active traders. The 30-nut chart provides excellent opportunities. Here I use the 9 EMA and 20 EMA. The 9 EMA captures short-term momentum. The 20 EMA identifies the underlying trend. When price action versus indicators explained, price remains above both lines. Momentum is healthy. When price begins closing below them repeatedly, caution becomes
necessary. But never enter a trade simply because two lines crossed. That is how amateurs think. Instead, ask yourself, who is in control, the buyers or the sellers? The moving average is not giving you a signal. It is revealing the psychology behind the price movement, and that distinction changes everything. The secret most traders never learn. The greatest mistake traders make is searching for the perfect indicator. There is no perfect indicator. There is only perfect discipline. The moving average is not designed to predict. It is designed to guide. Think of it like a compass. A compass doesn't tell you where treasure is buried. It simply keeps you moving in the right direction. The same is true for trading. Your job is not to predict every market move. Your job is to align yourself with the highest probability opportunities. And moving averages help you do exactly that. The market pays trend followers. It punishes prediction addicts. Never forget that, because the moment you stop trying to predict and start learning to follow, everything changes. And that is where consistent profitability begins. The difference between amateurs and professionals. Now let me tell you something that took me years to understand. Most traders believe success comes from finding the perfect entry. Professionals know success comes from managing risk and staying with winning trends. That difference changes everything. I've watched thousands of traders enter the market with excitement, confidence, and certainty. Then a small pullback happens. Fear appears. Doubt follows, and suddenly they're closing profitable trades before the real move even begins. Why? Because they trust their emotions more than their system. The moving average solves this problem, not because it's magical, but because it gives you an objective reference point. It removes opinions. It removes predictions. It removes hope. And hope has destroyed more trading accounts than any market crash ever could. When price stays above your chosen moving average, the trend remains intact. When price closes below it consistently, conditions are changing. Sybil. Yet most traders ignore simplicity because simplicity feels boring, and the market rewards boring. Why most traders fail with moving averages. Let's talk about a painful truth. Most traders don't fail 200 EMA long-term trend secret because their strategy is bad. They fail because they cannot follow it. Imagine a trader using the 20 EMA. Price pulls back. Fear enters his mind. He exits. Then the trend resumes and moves hundreds of points higher. Now frustration appears. He jumps back in. The market immediately retraces. He panics again. And before long, he's trapped in an endless cycle of emotional decisions. The problem wasn't the moving average. The problem was psychology. Markets are designed to exploit emotional weakness. Every pullback creates fear. Every rally creates greed. Every loss creates doubt. And every winning streak creates overconfidence. The crowd reacts emotionally. The professional reacts strategically. That distinction separates wealth from disappointment. Understanding market structure. A moving average becomes significantly more powerful when combined with market structure. Never use it in isolation. Look at what price is actually doing. Is it creating higher highs, higher lows, lower highs, lower lows? These patterns reveal the true direction of the market. The moving average simply confirms what price is already telling you. Suppose price is above the 50 EMA. At the same time, the market continues creating higher highs and higher lows. Now you have alignment. Trend momentum confirmation probability begins working in your favor. But if price remains above the moving average while creating weak structure, caution becomes necessary. Always remember, price is the truth. Everything else is secondary. The power of patience. Patience made me more money than intelligence ever did. Most traders cannot sit still. They feel a constant need to trade. Every candle looks like an opportunity. Every movement appears significant. But the market doesn't pay activity. It pays accuracy. The best trades often require waiting, sometimes for days, sometimes for weeks, sometimes for months. A moving average helps identify these moments. Imagine price trading far above the 20 EMA. The crowd becomes excited.
Social media becomes bullish. Everyone starts talking about easy money. That is often when experienced traders become cautious. Why? Because markets move in cycles. Expansion, contraction, expansion, contraction. Priest eventually returns toward its average, and when it does, opportunities emerge. The patient trader waits. The impatient trader chases. Only one survives long term. The psychology behind pullbacks. Most traders fear pullbacks. Professionals welcome them. Think about it. If a stock moves straight upward without pause, where will you enter? You need retracements. You need corrections. You need temporary weakness. Because weakness often creates opportunity. The 20 EMA and 50 EMA frequently act as dynamic support. During strong trends, priest pulls back, fear spreads, weak hands exit, strong hands accumulate, then the trend continues. This pattern has repeated throughout market history. Not because indicators create it, 50 EMA institutional direction, because human psychology creates it. Fear creates pullbacks, greed creates breakouts, and the cycle continues forever. The importance of multiple time frame analysis. One of the biggest mistakes traders make is focusing on only one time frame. Markets don't operate that way. Think of the market like a river. The daily chart determines the river's direction. The 4-hour chart reveals the current. The 1-hour chart shows the waves. The 30-minute chart shows the ripples. When all time frames align, powerful opportunities emerge. Suppose the daily chart trades above the 200 EMA. The 4-hour chart trades above the 50 EMA. The 1-hour chart remains above the 20 EMA. Now momentum aligns across multiple dimensions. These are the situations professionals seek. Not random setups, not emotional trades. Demand and alignment creates probability. The biggest lie in trading. The biggest lie ever sold to traders is this: you need more indicators. You don't. In fact, most traders already have too many. They cover their charts with RSI, OPSI, D-stochastics, Balabands, volume indicators, custom indicators, accurate indicators, and somehow become more confused than before. The market isn't complicated. Human emotions make it complicated. The greatest traders focus on a few important variables and ignore the rest. Trend, risk, psychology. That's it. The moving average fits into this framework beautifully because it simplifies decision-making and simplicity scales. Complexity breaks under pressure. Risk management, the real holy grail. Let me share something few people want to hear. Risk management matters more than your moving average settings. You can have the best settings in the world. If your risk management is poor, you will eventually fail. Markets are uncertain. Losses are unavoidable. No strategy wins every trade. No moving average predicts every move. Professionals understand this. Amateurs resist it. Every trade should have a predefined risk. Every trade should have a planned exit. Every trade should assume the possibility of failure. This isn't pessimism, it's professionalism. The market rewards those who prepare for uncertainty, not those who ignore it. How institutions think. Most retail traders focus on individual candles. Institutions focus on trends. This difference explains many market movements. Large funds cannot 20 EMA momentum strategy enter and exit positions instantly. Their size prevents it. They accumulate gradually. They distribute gradually. And these activities often create the trends visible through moving averages. When a major institution begins accumulating shares, the process can last weeks or months. The 50 EMA begins rising. The 200 EMA begins rising. Priest respects these averages repeatedly. This isn't coincidence, it's money flow, and money flow leaves footprints. The moving average helps reveal those footprints. Staying calm during volatility. Volatility tests every trader. Markets move violently. News spreads, fear increases, emotions intensify. This is where discipline matters most. A trader without rules becomes emotional. A trader with rules remains focused. The moving average provides structure during uncertainty. Instead of reacting to every headline, you observe the trend. Instead of listening to opinions, you watch price. Instead of panicking,
you execute your plan. And over time, this consistency creates confidence. Not the confidence that comes from being right, the confidence that comes from being disciplined. There is a profound difference. The final lesson. If I could leave you with only one lesson, it would be this. Stop searching for certainty. It doesn't exist. Not in trading, not in investing, not in life. The market is a game of probabilities. Your objective is not to predict every move. Your objective is to align yourself with favorable conditions and manage risk intelligently. The 200 EMA helps identify long-term direction. The 50 EMA reveals intermediate trends. The 20 EMA captures momentum. The 9 EMA highlights short-term strength. Together, they provide clarity. But remember, indicators don't create profits. Discipline creates profits. Patience creates profits. Risk management creates profits. Emotional control creates profits. The moving average is simply a tool, a compass, a guide. Nothing more, nothing less. And if you learn to use it correctly, you will begin seeing the market differently than the crowd. You'll stop chasing. You'll stop
9. EMA short-term timing edge. Guessing. You'll stop reacting emotionally. Instead, you'll follow trends. You'll manage risk. You'll think like a professional. And that is the moment everything changes. Because the greatest fortunes in market history were not built by predicting every move. They were built by identifying major trends and having the courage to stay with them. The trend is your friend. It always has been, and it always will be. The art of sitting tight. There is one lesson that made me more money than any chart pattern, indicator, or market prediction. The art of sitting tight. Most traders never master it. They believe trading is about constant action, buying, selling, entering, exciting, watching every tick, reacting to every candle. But the greatest profits are often made not in the buying or selling, but in the waiting. I learned this lesson through expensive mistakes. Whenever I became impatient, the market punished me. Whenever I forced trades, the market humbled me. Whenever I tried to outsmart the market reminded me who was in control. Eventually, I realized something. The money isn't made in the thinking. The money is made in the sitting. When a strong trend develops and price respects the moving average, your greatest challenge becomes psychological, not technical pots, because your mind constantly wants to do something. Take profits, move stops. Close is the position, lock in gains, protect yourself. And while risk management is important, premature action destroys market psychology behind pullbacks many winning trades. The market often rewards patience far more than intelligence. Why traders exit too early? Imagine a stock moving perfectly above the 20 EMA. The trend is strong, momentum is healthy, institutions continue buying, everything looks good. Then the stock pulls back slightly. Immediately fear appears. What if this is the top? What if I lose my profits? What if the market crashes? These thoughts begin attacking your confidence. Most traders surrender. They close the trade. A few days later, the stock continues higher. The trend survives, the opportunity remains, but they're no longer participating. This cycle repeats thousands of times every day across financial markets. Not because traders lack knowledge, because they lack emotional control. The market continuously tests your ability to stay committed to a valid position, and the moving average can help you remain objective during those moments. As long as the trend remains healthy, why leave? As long as price respects the structure, why panic? The answer is simple: emotion. And emotion is often the enemy of profit. The crowd is usually late. One of the most fascinating aspects of market psychology is timing. The crowd is usually late. When prices are falling, the crowd becomes bearish near the bottom. When prices are rising, the crowd becomes bullish near the top. This pattern has repeated for generations. The headlines simply change. The emotions never do. A rising 50 EMA, often multi-time frame trading system, begins signaling strength long before the crowd notices. By the time financial media starts celebrating a trend, professionals have usually been participating for weeks or months. That's why understanding moving averages matters. They help you focus on what the market is doing rather than what people are saying. Opinions are endless. Price is reality, and reality pays. Confidence comes from repetition. Many traders ask, "How do I become confident?" The answer surprises them. Confidence does not come from winning. Confidence comes from repetition, following your process, executing your rules, managing risk consistently again and again over time. This creates trust, not trust in the market, trust in yourself. A trader who trusts himself remains calm during losses. A trader who trusts himself remains disciplined during winning streaks. A trader who trusts himself doesn't chase every opportunity because
He knows another opportunity will come, and that mindset is incredibly powerful. The market rewards consistency, not emotional extremes. The future belongs to disciplined traders. Technology changes, markets evolve, new assets emerge, new strategies appear. But one thing never changes: human nature. Fear still exists, greed still exists, hope still exists, and uncertainty still exists. That's why the principles behind moving averages remain relevant. Not because they're modern, not because they're sophisticated, because they reflect human behavior. Every trend represents collective psychology. Every breakout represents shifting expectations. Every correction represents emotional discipline and patience mastery imbalance. And the trader who understands these forces gains an enormous advantage. You don't need hundreds of indicators. You don't need secret algorithms. You don't need perfect predictions. You need discipline, patience, risk management, and the ability to recognize a trend when it appears. That's what the greatest traders understood, and that's what separates professionals from gamblers. So the next time you open a chart, remember this. The goal isn't to predict the future. The goal is to observe the present clearly. Use the 200 EMA to understand the long-term picture. Use the 50 EMA to identify the primary trend. Use the 20 EMA to track momentum. Use the 9 EMA for short-term precision. Then let the market do what it does best: move. And if you have the patience to follow rather than predict, the discipline to manage risk rather than chase excitement, and the wisdom to trust the trend rather than your emotions, you'll discover what so many traders spend years searching for: consistency. Because in the end, trading success isn't about finding a magical indicator. It's about becoming the kind of person who can execute a simple strategy with unwavering discipline. And once you achieve that, the market becomes a very different place. Not a battlefield, not a casino, but an opportunity. One that rewards patience, preparation, and professionalism. And that, my friend, is the real secret behind every great trading fortune ever.